Hello and welcome back to the next episode of Risk versus Reward. As always, we have with us Hari Vishwanath, who's the chief of our research team, titled Portfolio. Welcome back, Hari. Nice to have you back.
Thanks, Bharat.
This week, we're going to discuss the two page one articles that appeared in the last two Sundays.
Yeah.
And I was really intrigued because, one, the Indian IT industry seems to be your favorite. Talk quite a lot about it and quite passionately. You also talk about the comparison with Accenture. That's a common recurring trend.
Yes.
And in the latest Sunday's article, you and our colleague Kumar Shankar Roy mentioned that it's impossible to decouple the fortunes of the Indian IT industry from a stock perspective from the global scenario.
Yeah.
And Accenture seems to be a favorite. Why Accenture? What is the benchmark?
So I will tell you why, to first your point on IT being a favorite sector. It's a sector that I've covered in depth for a long part in my career. Like before I joined BusinessLine, I used to work as a research analyst for a US hedge fund, and I used to track technology stocks. Okay, so I've kind of seen different technology companies, seen companies grow and fall, seen new entrants come and take the top slot, and I've seen the services companies and the product companies. Okay. And I've seen the evolution of the industry over the last 2 decades. And so IT is something, Indian IT is, you could say when it comes to technology in India, IT services has been the main elephant in the room in the last few years, with stocks correcting due to artificial intelligence. So one thing is, first in 2024 April itself, we published an article. While IT was on a recovery then, okay, the IT technology stocks had corrected and then they were on a recovery in 23 and 24. In April 24, we published this view that while Indian markets can decouple from global markets, IT stocks cannot. Because IT stocks business model in India is very similar to the services business model in the US, Accenture, Capgemini, etc. So a foreign investor is not going to choose a TCS over an Accenture if TCS is overvalued relative to Accenture. Okay, so in stocks you have two factors. One is absolute valuation, like relative to your earnings growth prospects, are you cheap or expensive? The other thing is relative valuation. Compared to another company, are you cheap or expensive? So what was happening in 24 were two things. One is IT services stocks were expensive on an absolute basis relative to their own earnings growth prospect. They were all trading at a valuation between 24 to 30 times PE. The other thing is Indian IT stocks were trading at a premium to Accenture. This is a point we mentioned in the article this time, and we mentioned in our article in April 2024 also. Accenture is the gold standard in IT services. See, the Accenture's revenue is almost twice that of TCS, okay? That is one thing. And then the other thing is TCS has higher margins than Accenture. So they kind of knock off each other. Normally you would give a higher margin company a better valuation. But in this case, investors should not do it, in my opinion, as a fundamental analyst, because Accenture has larger scale. Okay, Accenture's scale is massive compared to any other Indian IT services company. So because of a larger scale, although it had lower margins, Accenture used to trade at a premium to Indian IT. So if you see in the chart that we have in this week's edition, we have given the split between pre-COVID few years, how Accenture was trading at a premium. And then post-COVID, there has been a euphoria in Indian markets, especially in IT stocks after the digitization boom that played out after COVID, and valuations went over the roof. Okay, so at that time, Indian IT stocks started trading at a premium to Accenture, and there are stocks with, at least in the case of TCS, you could argue, okay, TCS has the highest margins in the industry, okay, 24, it's always between 24 to 26%. Infosys is 21%. HCL Tech is 18-19% margins. Accenture is 16-17. HCL Tech is trading at a significant premium to Accenture. Fundamentally, these things have to correct. That is what we wanted to point out. So as it is, we are seeing an exodus of FPIs. Now, why should an FPI choose a HCL Tech over an Accenture. And we have given these other interesting numbers here. We did, so the last 10-year EPS CAGR you do, right? Accenture's EPS CAGR is the highest at 10%.
Compounded annual growth rate.
Compounded annual growth rate from FY16 to FY26. Accenture's earnings growth is the highest in dollar terms, okay? Accenture reports in dollars. Indian companies report in rupees. So if you look at dollar to dollar comparison, Accenture is 10%, TCS Infosys are at 6%, Wipro is much lower. Okay, so but all these companies are trading at a premium. Even if you factor in the rupee benefit, okay, the currency benefit which boosts the earnings of Indian companies because their margins get a boost from currency benefits, their rupee earnings CAGR in the last 10 years is still lower than Accenture's dollar revenue CAGR. Okay, so that is one thing. So Accenture has grown faster, is the largest company in the industry, is trading at a 10 PE, while Indian companies are trading at a PE of between 15 and 20 times. We wanted to highlight this. We highlighted this in 2024. We wanted to revisit and point it out again. So this is because we keep getting emails. I mean, people ask us, IT stocks, are they cheap, etc. So we try to address readers' concerns via our articles. We said in February this year that do not get into IT stocks because they are correcting. We compared it with the handset industry that got that got disrupted when iPhone entered. Actually, how BlackBerry, Nokia continued to fall. They all crashed 90%. See, disruptions. When there is disruption, you have to be cautious about buying the dip actually, because disruption means the future is changing. It's not the same as before. So a stock corrected 50% because of a disruption. You have to understand what is going to happen before thinking, oh, it's cheap and all that.
Awesome, lucid as ever. That actually brings me to my next question. You probably part answered it, but I'd like you to elaborate on that.
Yeah.
And you put it very well. When I look at a person as an entity or a company as an entity, how am I or how are we doing compared to our own past performance, or how are you doing compared to peers?
Yeah.
Right. In this context, I like the sentence that you and Kumar used in the latest article that appeared last Sunday. Is in the rear view mirror, the view seems good because, you know, compared to earlier, we seem to have done better now, or we are cheaper to buy.
Yeah.
But how does the future look?
Yes.
I'd like you to elaborate a bit on that because you seem to have evaluated technologies that are changing the landscape.
Yes. So it's like saying, for example, let's say Sachin Tendulkar at the age of 36, 37. His track record, perfect, amazing. So you can say many Indian IT companies have done amazing things, okay?
Yeah.
But could you expect the same out of Sachin Tendulkar from into the future? That's why, I mean, people retire. Companies don't retire, but companies that do well in future have to invest in new engines of growth. Indian IT companies did not invest in new engines of growth in the last 10, 15 years. And they were given up most of the cash they earned in the form of dividends and buybacks. So you have looking at a 10 years of lost opportunity in investing in new engines. So now they will have to start fresh in investing. So you can't look at the rear view mirror because the rear view mirror was a pre-AI world, pre-artificial intelligence world. Now in front of you, you have a world with AI. And how is the business model changing, right? So the general things that I'm able to gather when I discuss with industry participants and all that is, there is going to be a lot of disruption, but what is going to be, but it is still in a flux, okay? But there is going to be massive disruption. I'll give you this particular example. I met a IT person, met a person who works for a captive company whose digital transformation is being aided by one of the Indian IT services company. And what he told me was that earlier for the same, to that IT company, what we thought was a contract that would be a 12-month contract, we now expect it to be delivered in 4 months, okay? So he said that is the change. So you're looking at like another, I see, we still don't know how these contracts are going to be structured, what is going to be the pricing, but you're looking at 66% compression in timelines. To that extent, there is going to be an impact in time-based billing and all that. So this is one example. See, so obviously we can't base all our opinions on just a single example, but this is something that one person told me. So that is a kind of disruption that is happening. We have to be clear that the disruption is massive. Let us not think that the stocks are down 50-60%. Everything is taken care of. I don't know. So we should be, right now we are in the zone where we don't know. Nobody knows. The CEOs of the company don't know what is the revenue growth going to be. The boards of the companies don't know. In fact, even if they give a comment, I will take it with a pinch of salt because they didn't see this coming. At BusinessLine, we've been writing about it, okay? But the CEOs and the boards did not see this coming. So when they see, I would like to look at some track record of how their guidance and actual performance fares before gaining more conviction on what they tell me about the long-term evolution of the industry. I mean, they've done a great job, okay? So nothing to take away from them, but you can fault them for not seeing this coming. So there is uncertainty on how exactly the evolution is going to be from here. So when people ask, are stocks cheap, should you buy? My point is, how do you decide to buy a stock or a company when you don't know what is going to be its revenue growth rate for the next 4-5 years, when you don't know what is going to be its profit margin for the next 4-5 years, when you don't know what is going to be its cash flow? Right now, it is a gigantic exercise in speculation. I can say the earnings CAGR can be 7%, 10%, 3%. Any particular scenario is justifiable based on the assumptions you make. This level of uncertainty has never been there for the industry.
So that's probably why you left readers with a question at the end of the article saying, has the post-COVID crash been priced in? And your first point about why Accenture should be the benchmark, and then the 66% compression, that single example that you talked about. Don't all of these data points give us some idea? Because sometimes, depending on sentiment, a stock or a sector can crash so low that no matter what the future is, you'll have a buying opportunity. You wouldn't go so far.
Yes, so in fact, this reminds me of a quote which I heard long time back. It's a quote I like a lot. It says, the courageous do not live forever, but the fearful never live. Okay, so obviously if you keep fearing, anybody is going to miss the opportunity. But the fact is, at this point, if you ask me, I don't know. Okay, so see, people can try out different strategies, okay? You buy, let's say you have 100 to invest. You invest 20 now. If it falls, if Indian IT companies fall to Accenture PE of 10 times, then you add more. But then you again add more if it falls. You need to have a strategy. See, investors will need to develop a strategy. All I can say is, the stocks are not slam dunk buying opportunities. They are not. Because there is uncertainty. Accenture is trading at 10 times. Indian IT is trading at 15 to 20 times. So why should an investor buy Indian IT instead of Accenture? A foreigner or an Indian, okay? Because today you can buy global stocks through your foreign broking account. So the thing is, they're not cheap. There are times when you can say, like the COVID crash, get in and buy March middle because it is cheap. Nifty was
fundamentals have not changed.
Yes, fundamental. Like you had a 40-45% correction in a few weeks, and there is a disruption. But on a 7-8 year basis, this will be taken care of. Those were slam dunk opportunities. This IT correction is not a slam dunk opportunity because of the uncertainty. So individuals will have to make up their mind. I wouldn't get in. Like I wouldn't. Anyway, I'm not. I can't buy stocks that I talk about. So that is one part of it. But for somebody, I would say that I will not be getting into let's say if I was allowed to buy, I would not be getting in at this point in time because there is massive uncertainty. But investors who want to be a little bit courageous, you'll have to have a clear strategy, how much you have to invest in a staggered manner, and be ready for any eventuality, because we've written about this lesson for IT investors from AI's iPhone movement, where iPhone came and destroyed BlackBerry, Nokia, and few other companies in the handset industry. So be open to any eventuality and then have your strategy.
Okay, that's probably why you should check out our pages. And we'd love to hear from you. Thank you so much, Hari.
Thank you. It was a nice discussion. Thank you.
Yep.